I saw a comment on a financial forum the other day that really stuck with me.
Oh, yeah.
Someone posted a screenshot of their trading chart. It was a mess. I mean, lines everywhere,
Mhm.
indicators flashing like a disco, and the top comment underneath was just, "Congratulations, you're gambling with fancy charts."
Ouch. Brutal. But
That's
honestly, it's often the most accurate description of what's happening on a beginner's screen.
And that is the tension we are diving into today. The source we're unpacking is a breakdown titled Forex Foundations, the line between strategy and gambling by a trader named Hamid.
Mm.
And right off the bat, I really appreciate this source because he isn't trying to sell us a signal service. There's no, rented Lamborghini in the background, no promise that you'll be working from a yacht by Tuesday.
No lifestyle marketing,
Yeah,
which is rare in the Forex space. I mean,
mm,
usually it's all about the destination, never the journey.
exactly. He claims he just wants to get to the truth of the industry. So here is the mission for this deep dive. We are going to strip away the hype and answer that provocative question. Is Forex trading actually a legitimate, learnable skill?
Or is it just a casino where the slot machines look like currency pairs?
Precisely.
And to answer that, we have to look at this through the lens of, well, the psychology of money. Because what's so fascinating about Hamid's perspective is that he posits that the answer to, is it gambling, isn't a simple yes or no.
What is it then?
It's actually, it depends on you.
That feels like a bit of a cop-out, though, doesn't it? Like, blackjack is gambling, chess is strategy. Usually the activity defines the category. You're saying Forex is fluid.
I am. Think of the market as like an auction house. It's just a mechanism where buyers and sellers agree on a price. The market itself is neutral. It doesn't care if you win or lose. It doesn't even know you exist.
That's even different.
Completely. So whether you are gambling or running a business depends entirely on how you interact with that mechanism.
Okay, so I am the variable. The user determines the nature of the game.
Precisely. By the end of this episode, you should be able to look at a trader or, look in the mirror and spot the specific mechanical and psychological telltales. You'll know if you're looking at a CEO of a trading desk or a guy pulling a lever at a slot machine.
Let's start with the gambler profile then, because I think we all have a stereotype in mind. Maybe someone sweating over a ticker tape or shouting at a screen. But practically, what does a gambler look like in a modern trading terminal?
According to Hamid, the gambler operates primarily on impulse. There is no predefined reason for a trade.
Right.
It's usually visual or emotional. Oh, that green candle looks big. It's shooting up. I need to get in now.
FOMO, fear of missing out.
Pure FOMO. But the deeper trait, and this is the dangerous one, is the one big win mindset.
The jackpot mentality.
Right. They aren't trying to generate a consistent 2% return on their capital this month. They are trying to double their account by Friday.
They want the market to pay off their car loan in 10 minutes.
Exactly. They view the market as a lottery ticket dispenser, not a financial instrument.
I imagine that creates a massive dopamine loop.
It's purely chemical. When you hit a trade like that, your brain lights up exactly like it does when you hit triple sevens on a slot machine.
Oh, wow.
The problem is that feeling is addictive. And because the market has what psychologists call variable reinforcement, meaning sometimes you win even when you do something stupid, you start thinking your luck is actually skill.
That's terrifying.
Yeah.
So you can be rewarded for bad behavior, which then reinforces the bad behavior.
Exactly. It's like you can drive drunk and get home safely. That doesn't mean you're a good driver. It just means you got lucky. But in trading, people mistake that luck for a system.
Until the luck runs out.
And then the account goes to zero.
Okay, let's flip the coin.
Yeah.
How does Hamid define the business of trading? If the gambler is chasing the high, what is the professional chasing?
Boredom.
Boredom. That's not a great selling point for a career. Come be a trader, it's thrillingly dull.
But it's the truth. The professional wants predictability. Hamid highlights that a professional views trading as a skill-based business. They deal in probabilities, not possibilities.
Okay, break that down for me. Probabilities, not possibilities.
A gambler thinks, it's possible this trade makes me $1 million. A professional thinks, okay, based on the last 100 times this pattern appeared, there is a 60% probability price moves up and a 40% probability it moves down.
So they play in the averages.
They are the house. Think about a casino. The casino doesn't care if you win a specific hand of blackjack. They don't sweat the individual outcome. Why?
Because they know they have a statistical edge.
Exactly.
Ah.
Over thousands of hands, the math guarantees they win. The professional trader tries to replicate that same house edge.
So if your heart is racing every time you click buy, you're probably doing it wrong.
If you're sweating, you're betting. That's the rule of thumb. Good trading should feel like data entry. It should be repetitive execution of a plan.
I love that. If you're sweating, you're betting. Okay, let's get into the weeds, because talking about mindset is easy, but the source actually gives us the math behind this. He talks about something called the edge and specific risk controls.
This is where we separate the dreamers from the pros. You can have the best psychology in the world, but if your math is broken, you will go broke. Hamid brings up a very specific number for risk per trade. 1%.
1%. Let's pause there.
Yeah.
Because if I'm a new trader with, say, a $1,000 account, risking 1% means I'm risking $10.
Correct.
I'm sorry, but nobody gets into trading to make 10 bucks. That feels agonizingly slow. I can see why people ignore that rule immediately.
And that impatience is exactly why they fail. The 1% rule isn't about how much money you make, it's about how long you survive. We need to talk about the math of drawdown. This is something beginners almost never understand until it's too late.
Drawdown. That sounds like a military operation.
It's the decline in your capital from its peak. Let's say you take the gambler's route. You want to get rich fast, so you risk, I don't know, 10 or 20% of your account on a single trade.
High stakes. Go big or go home.
Right. Now, if you lose 50% of your account, which can happen in just 2 or 3 bad trades with that risk size, how much do you need to make to get back to break even?
The logic would say if I lose 50%, I need to make 50% back.
And that is the trap. If you have $1,000 and you lose 50%, you have $500 left. To get back to 1,000, you need to turn 500 into 1,000. That is a 100% gain on your current balance.
Oh, wow. I never thought about it like that. The hole gets deeper the further you fall.
Exponentially deeper. If you lose 90% of your money, you need a 900% gain just to get back to zero. That is mathematically almost impossible for a beginner.
But with the 1% rule.
If you stick to Hamid's 1% rule, you can lose 20 trades in a row, which is actually hard to do if you have any strategy at all, and you still have roughly 80% of your capital. You are still in the game.
So the 1% rule is basically an insurance policy against your own stupidity.
Or just bad luck. Even the best strategies have losing streaks. The professional anticipates the losing streak. The gambler pretends it won't happen. The 1% rule buys you the most valuable asset in trading, time. Time to learn without going bust.
This leads into a really counterintuitive point in the source, the concept of accepting loss. Most of us are raised to think losing is a failure. If I fail a test, I didn't study enough. If I lose a client, I messed up.
But in trading, a loss is just a business expense. This is a critical pivot point for you, the listener.
Explain that. How can losing money be just a business expense?
Think of a coffee shop. To sell coffee, they have to buy beans, cups, pay for electricity, pay the barista. Those are costs. The owner doesn't cry every time they buy a bag of beans, thinking they are losing money. They know they sell the coffee for more than the beans cost.
Okay, that makes sense.
In trading, a losing trade is just the cost of doing business. It's the cost of the beans. You pay the loss to find out if the trade would have worked. The source emphasizes that professionals don't try to win every trade. They try to manage losses and let the winners run.
That reminds me of the concept of risk to reward that he mentioned.
Exactly. This is the other half of the math equation. If I risk $10, my cost of beans, to potentially make $30, my coffee sale, I can actually lose more times than I win and still be profitable.
Wait, run that by me again. You can have more losing trades than winning trades and still make money.
Yes. If you have a 1-to-3 risk-to-reward ratio, imagine you trade 10 times, you lose 7 times, that's minus $70. But you win 3 times at $30 profit each. That's plus $90.
So 90 minus 70. You made 20 bucks. Even though you were wrong 70% of the time.
Exactly. That completely shifts the paradigm, doesn't it? It's not about being a prophet who knows the future. It's about being a risk manager who structures the bets correctly.
That is mind-blowing for anyone who thinks trading is about predicting the market. The gambler needs to be right to feel good. The professional just needs the math to play out.
Bingo. And that creates a completely different emotional state. The professional isn't devastated by a loss because the math accounts for it. The gambler is devastated because they just lost their rent money on a hunch.
So we have a logical mathematical approach. Risk 1%, look for good risk to reward, accept losses as overhead. It sounds incredibly reasonable. So why does the source claim that 90% of people fail?
Hamid calls it the shortcut trap.
The shortcut trap. Is this where the get-rich-quick gurus come in?
They play a huge part. The internet is flooded with people selling the result without showing the process. You see the stacks of cash, the travel, the freedom, and you think, I want that, and I want it now.
It's the Amazon Prime mentality. We want same-day delivery on wealth.
And the market is the worst place to look for instant gratification. The source has a quote that I think is the anchor of this entire discussion. The market isn't against you. Your emotions usually are.
That's deep, because I think new traders often feel personally attacked. You buy, and the price immediately drops. It feels like the market is watching you.
It feels personal, but it's structural. The market is just a collection of order flow. It's neutral chaos. The chaos isn't out there. It's in your own head. It's your reaction to the red number on the screen.
And that reaction drives the specific behavioral errors Hamid lists: overtrading, over-risking.
Let's look at revenge trading. That is a classic emotional response. You lose $100, you feel stupid, you feel angry, so you immediately place a bigger trade to make it back.
Trying to force the market to apologize. Give me my money back.
Exactly. And the market usually responds by taking even more money. It's a tantrum. A professional trader has to essentially parent themselves. They have to say, no, we took a loss. That's enough for today. Close the laptop.
That requires an immense amount of discipline.
It does. And that brings us to the timeline adjustment. Hamid is brutally honest here. He says, think months and years, not days.
Which is a tough sell for the TikTok generation where everything is 15 seconds long.
It is. But think about any other high-income profession. A surgeon, 10 years of school, a professional athlete, a lifetime of training. Why would financial markets, which are arguably the most competitive arena in the world, be mastered in a weekend seminar?
It's delusional when you say it out loud.
Yeah.
But the marketing makes it look so easy. Just download the app and press the green button.
That's the barrier to entry illusion. It is easy to start trading. It is very hard to stay trading. Hamid argues that discipline is the currency. You aren't paid for your time. You are paid for your discipline to stick to the rules when your emotions are screaming at you to break them.
So for the listener who is sitting there thinking, okay, you've scared me straight. I don't want to be a gambler. I want to build this skill correctly. Hamid outlines 3 pillars for beginners. Let's walk through them.
Sure, and pay attention to the order because it really matters. You can't skip the first one.
Pillar number 1, risk management.
We've hammered this home, but it bears repeating. It is the foundation. If you don't have risk management rules, like that 1% stop loss, you don't have a strategy. You have a ticking time bomb. It doesn't matter how good your analysis is if one bad trade wipes you out.
It's the seatbelt. You don't drive without it, no matter how good of a driver you are.
Precisely. Pillar number 2, one simple strategy.
Emphasis on simple.
Yes. New traders often suffer from analysis paralysis. They put 20 different indicators on their chart. Moving averages, RSIs, Bollinger Bands. The chart looks like a plate of spaghetti. You can't even see the price candles anymore.
They think more data equals better decisions.
They think more complexity equals more accuracy. But usually it just adds confusion. Indicators often contradict each other. One says buy, one says sell. Hamid advises focus over complexity. Pick one way of looking at the market. Maybe it's just support and resistance. Maybe it's just a trend line break. Master one thing before you try to do everything.
Bruce Lee style. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times.
Perfect analogy. Be the Bruce Lee of one specific market pattern. Don't jump from strategy to strategy every time you take a loss. That's called system hopping, and it keeps you a beginner forever.
And finally, pillar number 3, emotional control.
This is the glue that holds it all together. You can have the risk plan and you can have the strategy, but can you execute it? Can you pull the trigger when you're scared? Can you hold the trade when you're greedy?
This is the internal game.
It is, and Hamid explicitly warns against the alternative here. The search for the magic indicator.
Oh, the holy grail. The algorithm that never loses.
There is a multi-million-dollar industry built on selling this lie. Buy my Superbot 3000, it makes money while you sleep. Hamid is very clear. If someone is selling a tool that never loses, why are they selling it for $49? Why aren't they just using it to buy their own island?
That is the ultimate logic check. If you had a money printer, you wouldn't sell it. You'd keep it in the basement and print money.
Exactly. The fact that they are selling it proves it doesn't work the way they say it does. The secret is that there is no secret. The secret is risk management, a simple edge, and psychological endurance. It's boring, hard work.
Which brings us back to where we started. The distinction between gambling and trading. It seems to me that trading becomes a business the moment you remove the hope and replace it with data.
That's a great way to put it. The gambler relies on hope, the trader relies on evidence.
And even if our listener never opens a brokerage account, never looks at a Japanese candlestick chart in their life, I feel like there is a huge takeaway here for just life.
Oh, absolutely. This is decision-making 101.
Right. Think about how we make decisions in our careers or relationships. How often are we gambling versus investing?
Think about it in terms of result-oriented thinking. In poker and trading, you can play a hand perfectly and still lose. That doesn't mean you made a mistake. It just means the probability didn't go your way this time.
But in life, if we get a bad result, we immediately think, I messed up. I need to change everything.
Exactly. We system hop in life too. We try a diet for a week, don't lose 10 pounds, and quit. We try a new marketing strategy for our small business. It doesn't work instantly, so we scrap it.
That's the gambler's mindset.
It is. The professional looks at the long-term data. Is the process sound? Yes. Then stick to it.
Detaching from the immediate outcome and trusting the process, that is incredibly hard to do.
It requires suppressing the ego. The ego wants to be right now. The professional is willing to be wrong now in order to be rich later.
So the market is just a very expensive place to learn who you really are.
It's the most expensive therapy session you'll ever have. But if you survive the learning curve, the skills discipline, risk assessment, emotional control transfer to everything else you do, you become less reactive and more strategic in every part of your life.
That is a fantastic place to leave it. We've moved from viewing Forex as a slot machine to viewing it as a mirror for our own discipline.
And hopefully saved a few listeners from blowing their accounts on a sure thing this weekend.
We can only hope. So here's the question for you to mull over today as you sign off. We've established that the difference between gambling and investing is purely about having a plan and managing your emotions.
And removing the jackpot mentality.
Right. So where else in your life are you operating like a gambler without realizing it? Are you gambling with your health by skipping the gym, hoping you won't get sick? Are you gambling with your career by coasting, hoping you won't get laid off?
Are you managing your life's drawdown, or are you just hoping for a lucky break?
Something to think about. Thanks for diving deep with us.
See you next time.